Good evening, ladies and gentlemen. This is Barry Norman on behalf of Alvexo and Investing.com, and welcome to our class on retracements and reversals. Now, tonight's class is sponsored by Alvexo, A-L-V-E-X-O, one of the world's leading Forex and CFD providers. Now, if you like, while we're in the class tonight, if you go to www.alvexo.com, you can open a demo account and follow along with us using their charts. Now, if you can't access Alvexo, it's because they're not regulated in your home country and they only offer services where they are regulated. Now, Alvexo is one of the leading providers of trading, and they've been around in the markets a very long time. All your funds are segregated and protected by the Investors Trading Fund. And when you trade with Alvexo, you can use their all-new web trading browser. Simply log in and trade. You don't have to download anything, and you get real-time quotes, one-click trading, and exceptionally good security. Or you can download their MetaTrader 4 platform to get the professional edge of trading. They also issue free signals twice a day, and they've got about an 88% accuracy, and there's no charge. They're either pushed out to you on the platform or sent to you by notification. You decide. Now, tonight's class is being recorded, and you can access a recorded copy of this class in about 24 hours by going to www.investing.com, where you enrolled in tonight's webinar, and look for the Education or Webinar tab on the top, and then click on Webinars on Demand. And in about 24 hours, you should see this class available there. Now, since Alvexo is a regulated provider, I'm required to read you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. Now, tonight we're going to be discussing two very important concepts: retracements and reversals. Now, spotting them is crucially important because a retracement and a reversal are part of trends, part of price action. And what happens is too many traders see an asset retracing itself and panic and think it's a reversal and jump out of the markets. Whereas they should be staying in the markets as long as they can define it as a retracement. Because markets don't move in a straight upward or downward movement. They move in push and ease, push and ease, push and ease. Now, there are rules about trends, and if you're not exactly sure how to define a trend, not a trend line, but a trend, we have whole classes in trend identification. But you have to understand that trends move in constructed manners, making higher highs and lower highs, higher highs and lower highs. And when you can identify these, you can trade them very easily, and you don't want to panic and sell out of a market too early, or you don't want to enter a market at too high of a price, because you want to let your asset run. You don't want to dump out here because, yes, you can always buy back into a market. Don't misunderstand. Just because you close the position doesn't mean you can't re-enter it as it starts to climb back up. But you will end up losing those big pips, and you'll end up paying the spread twice as many times. So you'll end up with a lot less profit. And you'll find yourself always in a mad panic. So the ability to point out the difference between a retracement and a potential reversal is a great tool to add your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement and a potential reversal. This is why the focus of today's webinar is to provide you with the information and knowledge needed to accurately determine whether an asset trend is forming a retracement or preparing for a reversal. Let me just get my markings off of here and we'll continue on here. Now, let's start off with some general definitions. What are retracements? Retracements are momentary reversals that occur during a longer trend. Now, you can have retracements in uptrends or downtrends. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset's price action. As you can see in the picture on the right, there are a couple retracements that take place and occur throughout a prolonged period of time. Now, if you imagine when an asset's moving up, at some given point, the buyers are going to start to say, the price is a little bit too high for me to buy into the market anymore. I'm going to sit on the sideline. So the buying pressure eases. While at the same time, buyers who bought in earlier are saying, you know what, I made enough money, my profit's high enough, I'm going to close my position and walk away happily with their profit. And they're selling to get out of their position. Now, this momentary ease, and it could go on for 5 minutes, it can go on for 2 hours, but this momentary ease allows the asset to fall. As that asset dips back down, a lot of those potential buyers that said the price was too high a little while ago, but now that it's eased back down, I'm going to buy into the market because they want to buy at the lowest price that they can buy. Okay, and then they start re-entering the market, pushing the asset back up. And as the asset starts moving back up, more and more buyers jump in the market. And then at a given time down the road, the exhaustion, or not the exhaustion, just the slow relaxation for a minute of the market takes place. And so this is very normal. Now, reversals are temporary changes in an asset's trend that occur over a short period of time. Oftentimes, these reversals can last for minutes, hours, or days. It just depends on what time frame you are utilizing for your charting solution. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during the asset price action like seen with retracements. In the picture that I'm going to show you, you will see an example of what reversals look like and what retracements look like. Now, Wall Street is chock full of investment idioms, but perhaps none is so broadly quoted as cut your losses short and let your winners run. Well, this is easier said than done, but this is what the whole thing about retracements and reversals are. Okay, because during a retracement, that's exactly what you should be doing, is let your winners run. When you can identify that it's now in a reversal, not a retracement, then you want to cut your losses. But how, in fact, is an investor to know whether a stock is merely retracing against an existing trend or if the trend has outright reversed? And this is a big question, because when you are looking at a trend and it's showing a retracement, at what point do you say, uh-oh, this isn't a retracement, this is a reversal, and if I'm in the market, I want to get out? Or I might want to sell into that market to get a position as the market's reversing. So it's difficult to know. Now, there are some things that we look at when we're trying to delineate between a retracement and a reversal. Volume is a key indicator, because when you're going into a retracement, volume should be easing down, but at some point, that volume should start to build back up. Where with a reversal, you're going to see institutional selling big blocks, getting out of the markets. You also have some chart patterns. Now, there are few of any reversal patterns that usually are, but can be usually limited to candles, where in reversals, several reversal patterns, and chart patterns, double tops, head and shoulders, can definitely tell you that you are entering a reversal mode. Okay. Now, the important thing is you must be aware of the fundamentals, because if there's a news headline, an economic event, any of these occurring, they don't necessarily denote a change in the trend, because You could have a very bad jobs report out of the US or a bad inflation report out of the UK and see the asset respond. But what's going to happen is that's not a reversal of trend. It's just a drop in value. And we still don't know if that asset's going to pick back up. Now, a lot of people rely on candlesticks. A retracement you can see with what we call indecision candles, dojis, things that the buyers and sellers are unaware, small bodied candles. Where reversals, we have very good candlestick patterns. These include bullish and bearish engulfing, the 3 black crows, 3 white soldiers, and other similar patterns. Okay. So there are ways that you can use or techniques you can use to identify these. Whenever a price reverses, most traders and investors are faced with a tough decision, because when price is reversing, okay, you have 3 options. You can hold throughout the sell-off, which could result in large losses if the retracement turns into a larger trend reversal. You can sell and rebuy if the price recovers, which will definitely result in money wasted on commissions and spreads and the difference in points between when you can act and react. You can sell, and the thing is, you can exit the market whenever you want. When you see it moving into a retracement, okay, you could close your position out, take your profit and go off somewhere else. That's perfectly fine. All it means is you made profit on your earlier trade. You just didn't make the maximum amount of profit. Well, maybe not being greedy can be very good. So by properly identifying the movement as either retracement or reversal, you can reduce costs, limit losses, and preserve gains. Now, the thing is, you need to determine the scope of the movement. Traders have an expression for attempting to pick a market top or bottom. They try to call it catching a falling knife. As an expression implies, it can be a downright dangerous and is not normally recommended. Now, the thing is, retracements and reversals are hard to pick because a retracement can look like a retracement as it moves down to a Fibonacci level, or as it moves to support and resistance until it breaks through that level. We're not exactly sure. So you have to be prepared, and you have to know where you should have your stop loss and what you should be prepared to do. At what point will you say, uh-oh, I need to get out of this asset, or it's reversing and I should be selling into that asset? Well, the first thing is you have to, number one, not panic. Number two, you have to be prepared for these because retracements are healthy. The whole idea is I don't want you to panic. I don't want you to take option number 3 and sell out of the market. Okay, I don't want you to have option number 2. I want you to understand that when you're better off when you see price moving up and then it retraces and moves up than seeing it straight climb. Okay. Because in a good retracement, and when you've identified that retracement and it starts to move back up into that uptrend or in the downtrend, whichever way it's going at the moment, you might want to increase your positions. So the market in general can become tired of moving in the same direction. It takes a lot of work and money to send assets to higher highs. And remember that word, and we're going to talk about the higher highs, higher lows, and lower highs. This is how you identify trends and what you're looking for in each peak and valley. As it peaks up, it needs to be making higher highs. As it goes down into the valley, it should still be making lower highs, which means that low it's coming down to should still be higher than the previous highs. Okay, it never will dip down to where that low was earlier. So when demand dries up, price begins to fall and causes the chart to head south. This causes the security to become more appealing to prospective buyers who believe the asset has potential to move higher, but were waiting for a better opportunity. As the price becomes more appealing at a lower point, these new buyers step in, creating demand, and once again, the price begins another leg higher. So what I have just described is a retracement. Retracements are healthy functions of a solid trend, and they are the proper time to enter a position on a trading asset. So you can see that after the retracement, the asset was unable to push to a higher high. So when you see the retracement and the asset pushes back up out of it, as moving up, but isn't able to make a higher high, you now see a reversal. A lower high is unhealthy, but is not the end of the bullish trend. It is possible that after setting a lower high, the asset could retrace again, never setting a lower low and then push above the previous high. The nail in the coffin of a bullish trend is the establishment of the lower low. Once the lower low is in place, your trend is over and is called a retracement. So in other words, when we see an asset moving up like that, then it eases back down to a proper ease, hits a support line, hits a Fibonacci retracement, does whatever, it comes down to where you are and starts moving back up. So what it did is it formed a higher high here, then it came down to a lower high, a higher low, and it bounced back up, and now it should actually technically be moving here to form higher highs. Okay. But it's not able to form the higher high, so it comes here and then it can retrace. Okay. Now it can retrace and bounce back up and move back up, or if it retraces and is unable and it makes a new lower low, comes down lower than this previous low in this retracement, you are now in a reversal. So once the lower low is in place here, your trend is over, and this is called a reversal, because at this point the bears are outweighing the buyers. That doesn't mean it's going to collapse and move into a downtrend, but it does tell you your uptrend is over, and what it will probably do is move into some sideways congestion till the markets decide what it wants to do. But this is a reversal. So in other words, you had the higher highs, you formed the retracement, came down, bounced off, and should have been moving to up here to the higher highs, creating higher highs, but it was unable to, and bounced off here and came back down, and then it came lower than your previous low. Okay, that is telling you no matter what it does next, that trend is on its dying breath. And this is called a reversal. This is when, if you're in the markets, you definitely want to get out. Okay. So reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. Okay. So if we notice here on this chart, see, price moved up, formed the higher high, came back down, but it was not able to form a higher high higher than where it was. It made a lower high and then bounced off of it and came down below its low here and then moved into a downtrend. Now, it doesn't have to move right into down. It can move into, like I said, sideways congestion. So at this point, isn't telling you to sell into that asset. It is telling you to exit the market and be prepared for a reversal of the downtrend, but we're not telling you how soon that might occur, because it can stay in congestion for a while. Now, the question is, what should you do? Because actually seeing these and defining it aren't all that difficult. Okay. Once you see them, and once you understand how the trends move, you can see the retracement and you can see the reversal. The fact is, if you're in the market, what do you do? And if you're not in the market, how do you how do you get into the market? So when faced with a possible retracement or reversal, you have three options. One, if in a position, you could hold on to your position. This could lead to losses if the retracement turns out to be a longer term reversal. You can close your position and re-enter if the price starts moving with the overall trend. Of course, there could be missed trading opportunities if the price moves sharply in one direction. And three, you could close permanently, and this could result in a loss if the price went against you, or a huge profit if you closed at the top or the bottom, depending on the structure of your trade and what happens after. But the thing is, you need to always be prepared, because reversals can happen at any time. choosing the best option isn't always easy. Okay. Now, there are techniques that we can employ that will help us, number one, identify these, and also let us know at what levels to expect them. Because just because we're forming lower lows and forming higher highs, we can identify the price points that this should be happening. And some of these tools that we can use are Fibonacci retracements, which is one of the most popular methods. We have pivot point support and resistance levels. We have trend support and resistance levels. We have chart patterns, and there's also all kinds of other strategies out there. Now, Fibonacci retracement tools are excellent tools for calculating the scope of retracement. They are most widely used in the foreign exchange market, but are also used in the stock market. And to use them, simply use the Fibonacci retracement tool to draw the lines at the top and the bottom of the latest impulse wave. Now, tonight's class is not about Fibonacci because Fibonacci takes about a 1 hour class. So we have whole classes of Fibonacci. Now we are going to look at it a little bit tonight, but you're not going to have, we don't have a great deal of time to explain each one of these in detail. So we're just trying to give you some kind of a scope. Tonight we're going to look at trend support and resistance. We're going to look at chart pattern. And in a short while, I'm going to run you a little video that was done by a friend of mine that's going to actually show you a better scope of using the Fibonacci's to help you identify retracements. Now, Fibonacci retracements are an excellent tool for calculating the scope of a retracement. They are most widely used in the Forex market. Now, in most cases, retracements will stay around 38.5 or 50% or 61.8. Now, Fibonacci tool is not difficult to use because today with all of our Java charts, all we do is locate the previous trend, not the current trend we're in, but the previous trend, and we identify the swing low and the swing high, and then we pull our Fibonacci tool across it, and it will automatically do the calculations and drop all of the retracement levels right on your screen. Now, there are many, many, many Fibonacci's. Okay, it's almost an endless sequence. But the ones for trading in the Forex market, the significant ones are the 38.2, the 50%, which is not actually a Fibonacci level. It's not part of the Fibonacci calculation, but because 50% is so important to the markets, because you'll find huge amounts of retracements and trend reversals happen at the 50%. So in other words, what you're saying is when the market climbed up here, okay, it has a good chance of retracing to 50% of its prior climb. Okay, and then it will recover off of there. And you can see how it hit the 50% level here, bounced back up, came back down. See how important this 50% level is? Came back up to the 23.6, back down to the 50 again, and then moved up to the 100 and kept on moving through. Okay. Now the thing is, Fibonacci are based on the previous trend movement and are extended forward as long as that trend still holds true. Now, when you end that trend and you have a new trend, whether it's an uptrend or downtrend, you then add your new Fibonacci, you add Fibonacci's onto the new trend, because in the markets, especially the Forex market, the market, it doesn't have rules and price action doesn't have rules, but the psychology of traders tends to send an asset retracing about 38.5 or about 50% of its prior move before the traders get back in and push it in the other direction. So in other words, in this case, if we saw it, when we saw it break the 38.2 level here, okay, we would have got into a little bit, not panic, apprehensive mode. So we need to have an alert because we want to watch it very, very closely to see what it does at the 50%. Now it could go down to the 61.8, which is another Fibonacci level, but at 50%, you need to be making a decision about what you're going to do. So think of it as an alert zone. Now we also have another alert zone by using what's called pivot points. And pivot points are easily available to you. Okay, pivot points are a calculation done with a pivot point calculator using a set of opens, highs, lows, and closes. And it will print out 3 levels of resistance and 3 levels of support above and below the current price, because you're only using it on the current price. And then you can draw these lines at these prices, and this will give you the 3 floors above and below the current price. So we have resistance, 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 support, and support. Support is what holds the price up as it's falling down. Resistance is what the price has to break when it's moving up. So imagine it's the floor and the ceiling of an elevator. To move up in that elevator, you have to break through that ceiling, and that ceiling then becomes your support above your feet. When you move up to that level, and you have to break through that next ceiling, which is your resistance. As you climb through that resistance, it becomes your new, and these are predetermined price levels. And a lot of times they work hand in hand with Fibonacci levels. And you'll see that the resistance support levels are almost exactly out the 50, the 61.8, and the 38.2, and they won't be exactly the same. But then you can actually draw yourself a little zone between the 2 different support and resistance levels and isolate it, because everything doesn't happen on the exact pip. But it'll help give you some better understanding of the retracement as price is moving down, because when price moves down, it should react at each one of those levels. Then next we have trend line supports. Now again, tonight in this class, we don't have the time to teach you how to draw a trend line. If you're not exactly sure, and you need to be sure because you need to know what the rules are to draw your support trend line in an uptrend or your resistance trend line in a downtrend, and then how, so here we drew the proper support line underneath the price as it was moving up. Okay, we had it validated by 1, 2, 3 points in common, and then we could draw the resistance line using the swing highs. Okay, and then what we have is a support and resistance zone around the price also. So if we combine this with the support and resistance levels off of pivot points, and then combine this with Fibonacci's, we've actually have 3 different tools that have isolated prices that we should see reactions on the chart. And it will help you to confirm reversals or retracements. Then you can use chart patterns. Okay, there are certain chart patterns that are established, and they're well established. And of course, they won't tell you 100%. But for instance, a head and shoulders is a very strong, when it fully develops, is a very strong reversal indicator. So in other words, when you form the left shoulder and then the neckline, the head, and then the right shoulder, and then it comes down and it breaks below the neckline, you are in reversal mode. So you're hoping that it bounces up. If it breaks through the neckline, and again, tonight we have a whole class on chart patterns, okay? And we will teach you about how to find the head and shoulders, how to define them, but we also teach you all about triangles, channels, and and every pattern you would see on a chart. Okay. Now, the most popular chart patterns are reversals and continuations. A reversal pattern signals that the prior trend will reverse upon completion of the pattern, while a continuation pattern signals that the trend will continue once the pattern is completed. Now, the most popular of these are triangles, symmetrical, ascending, and descending triangles. Now, when you see a triangle occur, as you can see, the price is being put into the center of a triangle where the pent-up demand is going to happen. Now, a triangle will not tell you whether it's going to break up or down, whether it's going to break out. As it gets towards the center of that triangle, where all the buying pressure is, it's going to break out. When it breaks out, it will either break out up or down. So this would help confirm whether you're looking at a reversal or a retracement. Now, the thing is, with a triangle, there's also formulas to judge the momentum of that move. So if you were to have that move and you have the breakout occur in the direction of the trend, you now can feel comfortable that that trend is going to continue, and you can actually calculate how much that momentum should push that asset up. But that means we're not going into a reversal. Whereas if it breaks down in an uptrend, we then know it's going into a reversal, or it's indicating it's a reversal. Now, remember, technical analysis is the study of historical price performance in an effort to predict future price performance through chart patterns. Price is the only accurate measure of investor sentiment, and it is the intersection of supply and demand. Investor sentiment is at least and possibly the more important determination of price than fundamental factors like earnings, revenues, profit margins, or economic events. There are three important principles that govern all technical analysis. First, price is not random. Second, price anticipates fundamental changes. And third, the relationship between price and time is linear. Different strategies have varying degrees of success depending on where the market is going. So you can't use any of these blindly, but when you combine several different tools to see a retracement or be prepared to see where a retracement should bounce off of or see the development of a reversal, you can then prepare yourself. But there's never a guarantee. But the more steps you use and the more accurately you can look at the price and understand what it's trying to tell you, the better you can trade in the markets. And triangles are a great tool, especially symmetrical triangles. They help you see exactly what is happening. And there's all kinds of strategies that will help you trade a symmetrical triangle. And it will generate buy signals, sell signals. But again, nothing works good on its own. But combining Fibonacci with triangles, with support and resistance, and a key element here would be volume, okay, would give you some very important understanding of the markets. Now, I'm going to run you a quick video that was done by a friend of mine, and she's going to help explain retracements and using Fibonacci, hopefully a little bit better than I do in this class. And then we'll go back on and wind up the class. So hold on, let me pop it up. It's only a few minutes long. We're going to watch it together. And this is a new service offered by Citrix. So we're just trying to master it. So let me pop it up here. Well, ladies and gentlemen, I hope that explained it a little better. I think she does a very nice presentation on understanding using the Fibonacci tool as well as seeking entry and exit points. Now remember, even a retracement that meets all the criteria may turn into a reversal with very little warning. The best way to protect yourself against such reversals is to use a stop loss point. So in that video, we demonstrated how to find a stop loss. You can estimate retracement levels using technical analysis and place your stop loss point just below these levels. Alternatively, you can place the stop loss just below the long-term support trend line or moving average. Ideally, what you want to do is lower your risk of exiting during a retracement while still being able to exit a reversal in a timely manner. So in conclusion, as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon and missing opportunities, holding on to losing positions, and losing money or wasting money on commissions and spreads. By combining technical analysis with some basic identification measures, you can protect yourself from these risks and put your trading capital to better use. And on that note, I'm going to say thank you very much for joining us. You'll be able to watch this video, recorded version of this class, in about 24 hours on investing.com. In the meantime, if you go to www.alvexo.com, you'll be able to set up a demo account with just your username and password and identify or use their charts as well as their tutorials to learn better on how to identify these levels. Thank you very much, and we'll talk to you again real soon. Have a good night now.